Welcome to the deep dive. Today, we are plunging right into that chaotic but really fascinating space where information meets finance.
Mm-hmm.
We've got a great stack of source material here, all exploring one critical relationship,
Mm-hmm.
how news actually translates into market action.
It's not just what the news is it? It's more about the architecture of how it lands.
That's exactly right, yeah. Our material today really zeroes in on identifying what we might call the voice of volatility.
Okay.
I mean, everyone knows news moves markets, that's obvious.
Mm.
But our mission here is to pull out the granular insights. How do traders really react? What are the sort of structural requirements for a story to actually move the needle?
Right.
We want to understand the true dynamics, the velocity, the direction, without trying to predict specific trades or, give financial advice. That's not the goal.
And that disclaimer is absolutely key. We're not crystal ball gazing here, predicting if the next jobs report sends things up or down.
This is about pure knowledge extraction. Understanding the sophisticated mechanics behind it all.
Yeah.
Because we've all seen it, right? Some huge headline drops and nothing. Crickets.
Yeah, happened all the time.
Then something else, maybe seemingly minor, triggers a total frenzy.
Right.
So we want to nail down what exactly differentiates those two scenarios.
Precisely. This deep dive is really about mapping out those mechanisms, the information flow, the key criteria news needs to meet, and the path it has to take to actually shift prices in a meaningful way.
Okay, let's unpack this then. We have to start right at the source, don't we? The elements that define an impactful story.
Mm-hmm.
Let's get into the anatomy of a market-moving headline. For you, the listener, trying to quickly scan a news feed, what specific things, structure, content, elevate a piece of news from just noise to something potentially volatile?
Well, what's really fascinating here, and the sources point this out, is that the market seems to require certain, let's call them structural characteristics, for news to really land with impact. And the most critical factor, it seems to be the element of surprise.
Surprise, not just good or bad news.
Exactly. It's not enough for the news to be objectively positive or negative. It has to be surprising or maybe contradictory to what everyone was already thinking, the existing consensus.
Ah, okay. So the key isn't just the size of the event, but the gap, the delta between what was expected and what actually happened.
You nailed it. That delta, that gap, that's the mechanism of market shock. Think about a company's earnings report, a classic example.
Right.
If analysts expected, say, $1 per share and the company reports 98 cents, well, technically that's an earnings miss.
Yeah, it sounds negative.
And here's the crucial bit. If the market had already kind of priced in a slight miss, maybe because of the company's own earlier guidance, then that headline, even though it looks bad on the surface, might just pass by. The expectation was already adjusted. It was baked in.
Makes sense.
Yeah.
So an expected miss is just like data confirming what we already suspected, not really a call to action.
Exactly. It's just data confirmation.
So what's an example of a real shock then? Something that wasn't baked in?
Okay, contrast that with something totally unexpected. An untelegraphed regulatory change. Let's say an industry regulator suddenly, overnight, mandates a new, super expensive environmental standard.
Ooh, okay.
That kind of news fundamentally changes the cost structure for every company in that sector, instantly. The whole consensus about future profits. Invalidated, just like that.
Right.
That sudden shift in the narrative, introducing this massive, unpriced uncertainty, that's the element you need to trigger real volatility among traders. Without that structural surprise, it's often just noise.
That distinction is so useful data versus a directive to act. Okay, so if the surprise factor sets the hook, then the speed of delivery must determine how quickly the line goes taut, right? How fast does this info actually hit the pricing engines?
Yeah, that brings us nicely to the next piece, the chain of influence, the actual operational mechanism.
That's how it travels.
Exactly. The typical flow starts with the source, could be a regulatory filing, an official press release, an economic data dump.
Standard stuff.
Standard stuff, but the timeline from creation to actual price impact is, well, it's razor thin. Speed is everything because basically the first mover, the first one to act on that new information, captures the value.
The microseconds matter. The latency gap is where the money is, or was.
Oh, they absolutely do, still do. The journey, as you put it, from press release to price impact, it relies heavily on what the sources call these ultra-fast distribution channels, specialized terminal services.
So we're not talking about tuning into cable news here.
Definitely not. No. We're talking about dedicated feeds, news wires plugged directly into the algorithmic trading engines of big financial institutions.
Wow. Okay.
These systems ensure immediate dissemination, often within milliseconds, to algorithms that can parse the headline, understand its sentiment, and fire off orders before a human trader has even finished reading the first sentence.
Okay, let me just clarify that for the listener. When we say ultra-fast channels, we really mean these direct data streams. And the wider the distribution across those high-speed networks, the faster and sharper the price correction will be, simply because all these algorithms are racing each other to internalize the new info.
That's the initial wave, absolutely. And it's
Yes.
largely mechanistic, almost automated. But, and this is where it gets really interesting in today's market.
There's more.
Oh, yeah. That traditional high-speed wire feed, that's just the beginning. We have to talk about the modern multiplier effect.
The social feedback loop, which can take that initial spark and turn it into a sustained fire, right?
Precisely. The speed of that traditional path, it sets the initial price adjustment. But the sustained volatility, the broader shift in sentiment, that often depends on what happens in the minutes and hours after the initial release.
Right.
And this is where we see, as the source material highlights, the role of social media in amplifying sentiment.
So social media isn't necessarily breaking the news first.
Not usually, no. Not the core financial data anyway.
But it takes that high-speed data point and basically throws it into this immediate, often emotional public square. A much wider group of traders, investors, commentators.
Exactly. Social platforms, they just exponentially increase both the reach and, crucially, the emotional intensity of the market reaction. It kind of democratizes the reaction, doesn't it?
Yeah.
It allows retail folks, secondary commentators, influencers, everyone to weigh in. They rapidly confirm or dispute the news, often adding layers of narrative, maybe interpretation, that might even go beyond the objective reality of the initial data point.
And this amplification, this layering can happen almost regardless of how credible the initial source was, right? It creates this scenario where momentum starts chasing sentiment, not just the cold, hard facts.
It absolutely creates a powerful feedback loop. If a narrative, maybe even one that's slightly twisted or exaggerated, gains enough traction, enough emotional heat on a big platform, the resulting sentiment shift can sustain volatility way beyond what the original factual press release might have generated on its own. It turbocharges the emotional side of trading, the fear and greed potentially overriding those purely rational algorithmic responses.
Okay, this analysis, thinking about surprise and then amplification, brings us right to that core puzzle the sources talk about, the volatility puzzle.
Right.
Why do some events, even ones that look like textbook market shocks, just fizzle out while others ignite? We've talked about the structural needs for action, but what sometimes stops that action from happening?
That's the crucial next step in putting it all together, isn't it? Because volatility isn't guaranteed. Even if the headline is shocking and the distribution is lightning fast. The lack of volatility or its presence, it's really a summation of conditions, and that includes factors that can actually dampen the shock, even nullify it.
Okay, because I worry if we just say, well, it needs surprise and good distribution, just kind of repeating ourselves. There must be other variables, external complicating factors.
You're exactly right. Let's bring in two critical complicating factors that can sometimes stop even a perfect market-moving headline dead in its tracks. Liquidity and information fatigue.
Okay, liquidity first. Let's say the news is shocking. It's out fast. Why wouldn't the market move if theoretically no one's actually there to trade?
Well, market liquidity is basically the depth, the readiness of buyers and sellers at any given moment.
Right.
So if a really shocking piece of news drops, let's say mid-afternoon on a quiet Friday in August.
Yeah, bad timing.
And there just aren't enough active players, enough volume, people willing to buy or sell at the current prices, then the volatility effect gets choked off. The gap between the bid and ask price widens dramatically, trading volume just dries up. So the market's reaction is muted, not because the news wasn't important, but because the actual mechanism for price discovery, the trading activity itself, was temporarily offline, effectively.
That makes sense. So the time of day, the day of the week, even the time of year, can structurally limit volatility, regardless of the news itself. Okay, what about information fatigue? That sounds more psychological.
It is. It's a really powerful counterpoint to the pure mechanics we've discussed. Information fatigue happens when the market has just been hammered by a whole series of high-impact events recently.
Right, like sensory overload for traders.
Exactly. Traders just become numb, almost desensitized to new shocks. If you've had, say, 3 major geopolitical crises, 2 central bank surprises, and maybe a natural disaster all hitting within, like, a week.
Okay, yeah, stressful week.
The market's capacity, its ability to react aggressively to a fourth negative piece of news is just diminished. People are worn out.
So the bar for what constitutes surprise actually moves higher. The next piece of unexpected news has to be even more jarring than what came right before it to get the same reaction.
Precisely. Think of it as a kind of collective cognitive load. The market just can't process and react intensely to everything all the time. So the reaction, or lack thereof, it's determined not just by how well the info fits that required architecture, the surprise, the distribution, but also by the market's current capacity to process and act on new risk. It's the sum of the content, the conduit, and the current market state, liquidity, and fatigue.
Wow, okay, that provides a really powerful analytical framework for our listener. So next time you see a market either crash or maybe more interestingly, not react to what seems like huge news, you got a checklist. Was it truly unexpected or was it already priced in? Was the delivery mechanism optimal, high-speed wires plus social amplification? And crucially, was the market maybe suffering from low liquidity or just plain information fatigue at that moment?
It's that confluence. Content, conduit, and capacity. Understanding how those three interact, that's really key to grasping how news actually works in today's very fluid, very interconnected market.
That is a deep dive completed. We've nailed down the anatomy of surprise, traced the mechanical path from source to price, confirmed the power of social media amplification, but also brought in those counterforces, liquidity and fatigue.
Yeah.
So what does this all mean for you as someone trying to understand how capital moves? It means volatility, yes, it's a structural phenomenon, but ultimately it's executed by humans. Humans under pressure.
And that leads us perfectly, actually, to the final provocative thought from our source material. If just understanding the technical mechanics, the pipes, and the headlines isn't quite enough to explain every trading decision,
right, there's still a gap.
Then we have to look inside. We have to turn to the internal, the psychological environment of the person actually making the decision.
Okay, I think I see where this is going. It shifts the focus from just the external shock to the internal readiness or lack thereof. So what subtle factor might influence a trader's focus when they're facing this absolute flood of volatile information?
Well, the source material actually teases an upcoming exploration, which sounds fascinating, into how subtle environmental factors, specifically things like music and soundtracks, might influence a trader's focus and mood.
Music? Really? How would that work?
Well, think about it. It relates directly to that cognitive load and risk appetite we just discussed. When a trader is dealing with massive amounts of incoming data, high volatility, which is inherently stressful, right?
Absolutely.
Their internal state, how calm or agitated they are, heavily influences whether they panic, freeze up, or actually execute their planned strategy efficiently.
So if the external information is telling them what they should probably do, maybe these internal stimuli, like the soundscape they're operating in, could influence how well they actually execute that decision.
Could be.
Affecting maybe the speed, the size, the aggressiveness of their trades. It sort of connects the big technical architecture of the market right back down to the fundamental psychology of taking a risk.
Exactly. The market moves on headlines, on algorithms, sure, but that ultimate split-second decision-making power, it still often rests with humans, and humans are influenced by everything from, data, latency, right down to the background music playing. It's another powerful layer of complexity to consider.
That's brilliant. A really fascinating dimension to add. Thank you for guiding us through both the structural and the human mechanics of volatility today.
My pleasure.
We really encourage you, the listener, to keep exploring this dynamic interplay between information flow, market capacity, and those subtle psychological factors. Until next time on The Deep Dive.
A pleasure.